Hello. Thought I'd make this video. I was having a conversation with Natasha just the other day, and we were talking about maybe why you should avoid investing in a company instead of a mutual fund or like an ETF, or ETF is exchange traded fund. So I thought I'd bring up an example of why you might want to think about staying away from investing in individual companies, right? And this is the example we looked at. I'm not sure if you're familiar with this company or not, but they make like arts and crafts stuff, and they make home supplies and home equipment where you can do custom prints and custom cutting, and they have a really interesting product. They have a really interesting product line. They have subscription based models, and they sell equipment and their supplies that go part of with it. So once you become a customer of them, they you kind of stay sticky to them. You stay loyal, and you continue to buy their products and buy their replacement stuff. I came across this company a while back as I was doing research on stocks of which companies to buy. You know, which companies had a good steady client base, proven sales and revenue and things of that nature. I came across this company back before I got learned before I learned more about the stock market in general. And this is a great example because this fits all the criteria. It's a small, it's growing. It's been around since 1969. Um, they're profitable, right? I'm not sure if they pay a dividend. I'm not sure if they paid a dividend in the past. You can see actually, I've bought and sold it a few times, and actually, it looks like I even took a loss on it. Yeah, a small loss. I bought $1,000 here and I sold it for 932 there. So yeah, good example. But anyway, what's neat about them is if you look at the fundamentals of the company, you think it makes sense. They're small, they're growing, they've got a great balance sheet. I always look for profitable companies, right? And if you were to bought it back here, back on the stock price, all these things were true last year too, right? All these things were true in October, and you would have paid $27 a share for it, and it fell to what? $10. There's nothing wrong with this company, and this company is going to be around. It's going to do great in the long run. But if you've done like I've done, and you'll buy a company based off its fundamentals, it falls with the market. The entire market falls. This will fall as well, as evidenced by what it's done. Right. I've made this mistake on other investments like Amazon, like Berkshire Hathaway, Smith and Wesson. These are all examples where I bought it with using a sound fundamental base of why I think this is a good company, just to watch it fall. Right. So this is why you want to avoid situations like this and move into situations like this. So the video should be claimed, or should be titled "What to Buy." So if you want to play on the stock market, what to buy. So that's probably the first video you might want to watch. Um, I start with TQQQ, right? And what this does is it looks at, all right, what is this? What does it actually do? Let's read it together. All right. It provides a 3 times leverage exposure to the NASDAQ, right? So if you look at just straight up QQQ, take off the T and read its description. It tracks a modified weighted average of 100 of the NASDAQ stocks. Long story short, you look at the NASDAQ, which follows technology sectors. They choose the 100 of the best performing ones, and they buy individual investments into that. I'm doing a horrible job of describing this, but long story short, when the overall industrial and technical market goes up, which really when the Dow Jones goes up, so does Nasdaq. When the Nasdaq goes down, so does Dow Jones. They usually follow the same path. You can just it's like picking Ford or Chevy. Might have reason for why or the other, but they're usually just about in general the same thing. They're trying to accomplish the same mission. You can track one, and sometimes there's deviations, and one will trail off. But in general, if you look over time, from my experience, it seems like Nasdaq and Dow. So I just chose Nasdaq because I'm a tech guy. Anyway, so when you look at TQQQ, every time this goes up $1, TQQ goes up $3. And the opposite is true. When this goes down, then SQQQ goes down $3. So why is it $3? 1 to 3. Why is that important? All right. You For investors, you really want to capitalize on the move and the swing of the market. especially if you know how to predict it. So if you can, and I can show you how to predict it. So if you know something's going to happen with great certainty, and if you can quote unquote put more on it, put more on the bet, the hedge, to know that, hey, I'm confident it's going to go in this direction. All my indications say it's going to go this direction. I want to put as much money as I can, right, to capitalize on it. But you don't have to take that strategy. You can use the strategy that I'm teaching just on a non-leveraged ETF, right? But long story short, trying to make this as simple as possible. Try to avoid buying individual companies, right? And looking at the stock as I have with my own investments, watching it fall and fall and fall. It's like, well, shit. I know this is a good company. I know this is going to make money in the end, but why does it keep falling? And when you're in this situation, all you do is watch your money. And as long as you don't sell, you don't lose, right? That's the good news. As long as if you bought it up here and you don't sell it, you don't lose a thing. You just got to wait. And while you're waiting, you're like, Jesus. So, if you know how to play both sides, if you're playing an entire market versus an individual stock, that's step one. Step two would be to get in and get out, right? If you're looking at like my triple Q, my SQQ, if I think that the market is going to continue to go down, right? If I think the market is going to continue to go down, I'm going to bet on SQQQ to continue to rise, because this guy goes up when SQQ, when QQQ goes down, right? And this is how you play both sides of the market. And I think I made a video where I could show where I've made money in the same day on the same investment. But there's a good example of where I've done just that, because the market started off heading, it was going negative, even though this is going up. It's kind of strange. It's kind of counterintuitive, but the market started right here at 9:30, right? Opened up, and it was kind of heading towards a bad direction. Peaked up, and then it fell. It turned around at 10 o'clock and fell like a brick, right? Now, if you look at the TQQQ, see what happens at the same time frame. Look at 10 o'clock on that time frame, right? Let's bring up here. Let me bring up 10 o'clock on that same time frame. Boop, 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 10 o'clock. What was the other one doing? Sinking. What's this one doing? Rising, right? So if you can ride, it's like a teeter totter. The best way I can describe it is a teeter totter. There's a kid on both sides of the of the of maybe I should draw an example. But it's you have a spot in the middle, you have a kid over here and a kid over here, and this one goes down, this one goes up, this one goes down, this one goes up. There's nothing fake about it. The board's not going to bend between the two kids. It's always going to be true. When this goes down, the other goes up. So once you understand that, then you track one religiously, like I do, like I try to track TQQQ. I track this religiously, right? And I know, well, shoot, if you're going down, I know what's going up. That's not a guess. And when this is going up, I know what's going down. It's not a guess. So which side do you be on? So if you look at the stock, if you look at an individual company, there's no getting out. This is going down, nothing's going up. Whoops, I guess I wait. I guess I wait for it to go back up. Forget that. This is offensive playing only. That's when you're playing the market offensively. If you have no defense, you have no way of protecting yourself when you're going down. So this is why I stick with the, you know, inverse pairs. So TQQ and SQQQ, they're not the only inverse pairs. There are several. You can look at them for, let's say, oil, gold, the financial sector, commodities, um, real estate. Every major sector in the market has a pro and has a con. You can either bet that the entire sector is going to go up, or the entire sector is going to go down, which is cool. I just choose NASDAQ because I think it's more interesting. But let me give you an example, because of course I track these things. I track because it's fun to play different ones every now and then. Yeah, the oil. I believe this is the one that I want. Well, I can tell you what I'm invested in right now, actually. Boil is natural gas. Where's going to be cold and here we go. It's kind of funny. Boil, right? This is for natural gas. This is for the pro side. When natural gas prices rise, this guy goes up. When natural price gases fall, this guy goes up. It's called cold. Kind of funny, right? It's an inverse pair. Once again, there is no breaking of this rule. If this goes up, this goes down, this goes down, this goes up. And once you understand that, you can sit back and track it. So you sit back and you watch the stock. So let's make it look a little easier for people who are not familiar with all these charts. Let's look over here and look at oil. Maybe sick of hearing about Q. Let's take a look at it real quick. Let's say this is a stock that you like, or you think for some reason that the oil or the natural gas is going to be going up. I certainly hope it does go up. Unfortunately, I wouldn't. It's not going to be good for my individual bills, but it'll be good for my investment. Because as you can see, I'm in at 37, but this was a speculative thing. This is an example of what not to do, right? I made money off this, and then I bought it, and I didn't sell out and then switch over to the cold side, to the other side. So right now, I'm waiting. I guess this is a good time for me to bring up another point. The great thing about investing in an entire industry is as I'm waiting, as I'm supremely confident that I'm at $37 a share now, right? That this is going to go back up, right? And the reason why it's going to go back up is you're not betting on one individual company. Well, not one individual gas company makes this up. Several hundred do, right? So if you bet on Circuit, if their CEO goes out and shoots Elon Musk in the face and the company goes bankrupt, you've lost everything. Every dime you've spent as you were waiting, if you were waiting for this to come up, oh, please come back up to 23, please. No, this company goes bankrupt, you've lost everything. You might get a penny per share versus the 23 or 24 you put in, right? In this case over here, this is not going bankrupt. Natural gas is not going away. There's always going to be a group of companies that are buying and selling natural gas, right? So you have confidence. So if you do, like I did, make a mistake, and I bought and I thought I was going to go up and it went down, I don't worry one bit. They're not going to go out of business. I'm not going to lose a dime. I'm just going to wait it out, right? So it's a huge advantage of not individually tying to a company, right? I mean, you can do it. It's kind of something. It's fun. You can get some quick, you can get some quick wins off looking at us. Look, maybe Tesla comes out and they're going to release a new product, and their stock. Everyone's going to get excited because the stock's going to shoot really high. You can take advantage of some of those quick rides, but I think for my investment strategy, what I try to maybe convince others to do is every time I get up to bat, I'm not trying for a home run. I'm trying for a bunt. I just want to get on base. I just want to make a small and a consistent profit, right? And without losing anything. I'd rather take that small bunt, and I'll get to base. If I bunt, most of the time I get on base, and so every time I get up the bat, everyone knows here comes the bunter. You damn right, and I get on base every damn time, every damn time. I'm not going for the home run, and I'm not going to freaking strike out, right? So that's the. I hope this kind of made sense a little bit. Talking about the inverse inverse pairs, inverse trading pairs. So you can look this up on YouTube or looking up on Google and to do some research on leveraged inverse pairs are and the types that are out there. But just like my biggest thing is like what to invest in and what not to invest in. Right? Do not try to avoid investing in individual companies, or you'll get burned like these poor people here that have been waiting since last year. It's a great company, and I'm sure in time, maybe 3 or 5 years, it'll come around and do all right. But why wait? Why? If you can't take advantage of the downside, then you're just waiting, right? Just lost opportunity here. I want the market to move one way or the other, and I can capitalize on both sides. All right, I made this video way too long. I hope some of the examples I gave made sense. I need to come back and give more videos on how I know which way the market's going to go and when to get in and get out, how to use some of these indicators. So, like I said, I hope these videos helpful. Thanks a lot for watching. Bye bye.